Hi everybody, Jeff Yastine here. You know, years ago, while working as a reporter for PBS Nightly Business Report, I had a realization that Wall Street isn't really about money. It's about fashion. You know, while interviewing dozens of market strategists each year, I would watch them spin stories that would make companies, sectors, and whole markets go in or out of favor with investors. And I realized that quite often nothing had really changed. A company that made ketchup or razor blades still made the same stuff in the year upcoming that it did in this year and that it did in the year past. And yet the only thing that changed was whether investors perceived that company's story as being either stale or exciting, either being in favor or being out of favor. And the sooner that we understand that, the better that we're going to be at spotting bargains and making money in the stock market. Now, a good example is in the consumer staples sector. These companies make consumer products that we all need and use up most weeks. You know, razor blades, toothpaste, soap, detergent, those sorts of things. And in less than a year, they've already made a big trip from being out of fashion to very much being in style. You know, it's a sector that I told everyone about back in May when it hit what I called a rare milestone at the time, and I'll tell you what that is in just a second. And according to market researchers, it was one of the only sectors that survived what October brought us in the way of a vicious sell-off and survived it with a net positive gain. Now, in fact, if you had bought Consumer Staples Select Sector SPDR ETF, the symbol is XLP, when I suggested it back in early March, you'd have a gain of more than 11% already in just 6 months. So let's suppose that you have not yet purchased the Consumer Staples Sector ETF and you're thinking about doing so. Should you still do it, even though this sector has moved up by about 10 to 11%? I would say yes. I have several of these more undervalued stocks in my model portfolio at Total Wealth Insider, and only a handful of them have really moved up in a significant way, like Procter & Gamble. Many investors are holding back on consumer staples with the idea that rising input costs and the uncertain trade situation present headwinds for this group, but in my view, a lot of this is going to clear up in the next couple of months. As recent economic headlines attest, Americans' wages are on the rise. That shows up very clearly in the economic data. So consumer staples companies have room to raise prices to help offset these rising input costs. Likewise, for the trade situation, we'll get a lot of clarity on that as the midterm election season comes to a close and the Trump administration assesses what it needs to do as it looks out to the next election cycle in 2022. So in my view, this sector, consumer staples, still has a long way to go. I expect the sector and the ETF, XLP, to hit around $65 by the middle of next summer, as investors recognize that this sector's outlook is as good as ever, and once again proving that Wall Street is a business of fashion rather than money. And if you'd like to learn more about this topic, about consumer staples, remember to click on the link for the video description and read my full article on Winning Investor Daily. I'm Jeff Yastine. Look forward to talking to you again.